The allure of $3,000 gold is stronger than ever. As of September 6th, the gold price closed at $2,526.80 per ounce. This significant milestone brings us closer to the $3,000 mark, making it a key factor to watch in the coming months. This ambitious target is not out of reach, especially given the numerous factors that could propel gold prices higher. The current global economic landscape is characterized by uncertainty and potential risks. These factors are historically bullish for gold, which is often seen as a safe haven asset. Investors tend to flock to gold during times of economic turmoil, as it is perceived as a store of value that can weather market volatility. After the Federal Reserve's anticipated rate cut in September 2024, the market saw mixed reaction. While some sectors anticipated relief with lower borrowing costs, concerns remained about the overall economic outlook. The rate cut was a response to cooling inflation and a softening labor market, with unemployment rising and job growth slowing. However, despite the rate cut, markets were volatile, with some investors worried that the US economy might still face recessionary pressures. In the immediate aftermath, lower interest rates helped reduce borrowing costs for consumers and businesses, but the benefits will take time to materialize fully. Sectors like housing may eventually see mortgage rates drop, though inflation risks persist. And some analysts warned that cutting rates too soon could rekindle inflationary pressures. Overall, the market is still digesting the full impact of the rate cuts and balancing optimism with caution. Historically, lower interest rates often support higher gold prices because they reduce the opportunity cost of holding non-yielding assets like gold. As borrowing costs decrease and inflation concerns persist, investors tend to view gold as a hedge against currency devaluation and economic uncertainty. With signs of economic softening, such as rising unemployment and slower job growth, the market might see increased demand for safe haven assets like gold. If inflation picks up again due to the rate cuts, this could further fuel gold's appeal as a store of value. While it's not guaranteed, these conditions provide a favorable environment for gold prices to potentially rise in the near to medium term. Thank you for watching. Please like and subscribe. Inflation has become a persistent concern in recent years, eroding the purchasing power of fiat currencies. When inflation rises, the cost of goods and services increases, and central banks often respond by raising interest rates. This combination of high inflation and rising interest rates creates a favorable environment for gold. Gold is often seen as an inflation hedge. Unlike fiat currencies, which can be printed by governments, gold has a limited supply. This scarcity makes it a valuable asset during inflationary periods, as its purchasing power tends to hold up better than paper money. Rising interest rates can also contribute to gold's appeal. While higher interest rates can make bonds and other fixed income securities more attractive, they also increase the opportunity cost of holding gold. However, if real interest rates, nominal interest rates minus inflation, remain low or negative, gold can still shine. In such a scenario, investors may view gold as a more attractive option compared to low-yielding or negative-yielding bonds. Therefore, the interplay between inflation, interest rates, and real returns plays a crucial role in shaping gold demand and influencing its price trajectory. And geopolitical uncertainty has become a defining characteristic of the 21st century. From trade wars and political instability to military conflicts and pandemics, the world is grappling with numerous challenges that create a sense of unease among investors. In times of geopolitical turmoil, gold often emerges as a safe haven asset. Investors tend to flock to gold during periods of heightened uncertainty because it is perceived as a tangible asset with intrinsic value. Unlike stocks, bonds, or other financial instruments, gold is not subject to the same level of counterparty risk. Its value is not directly tied to the performance of any particular company, government, or economy. When geopolitical tensions rise, investors often seek refuge in gold, driving up its demand and price. For example, during the 2008 financial crisis, the price of gold surged as investors sought safety amidst the market turmoil. Similarly, gold prices rose in response to the COVID-19 pandemic and the Russian invasion of Ukraine. As long as geopolitical uncertainty persists, gold is likely to remain an attractive asset for investors seeking to preserve their wealth and hedge against potential risks. Section 4, economic slowdown. Gold thrives on uncertainty. The possibility of a global economic slowdown or recession is another factor that could propel gold prices higher. Economic slowdowns are often characterized by declining growth, rising unemployment, and decreased consumer spending. These conditions can create a climate of fear and uncertainty, leading investors to seek safe haven assets like gold. During economic downturns, central banks often lower interest rates and implement other monetary easing measures to stimulate growth. These actions can weaken fiat currencies, making gold more attractive as a store of value. Furthermore, gold mining companies, like any other business, are impacted by economic conditions. A slowdown or recession can lead to reduced investment in exploration and production, potentially impacting future gold supply. This potential supply constraint, combined with increased demand from investors seeking safety, can create upward pressure on gold prices. Therefore, a prolonged period of economic weakness or a full-blown recession could significantly benefit gold, potentially pushing its price towards the $3,000 target. Section 5, central banks and gold, a growing appetite. Central banks around the world play a significant role in the gold market. In recent years, central banks have become net buyers of gold, adding to their reserves and contributing to the upward pressure on gold prices. This shift in central bank behavior is driven by several factors, including diversification, de-dollarization, and a desire to hedge against geopolitical risks. Traditionally, central banks held a significant portion of their reserves in US dollars. However, the global financial crisis of 2008 and subsequent events have led some central banks to question the long-term stability of the dollar-dominated monetary system. As a result, many central banks have been diversifying their reserves by increasing their gold holdings. Gold is seen as a safe haven asset that is not tied to any particular currency or economy, making it an attractive alternative to holding large amounts of foreign exchange reserves. The growing appetite for gold among central banks is a bullish sign for the precious metal. As central banks continue to accumulate gold, it reduces the available supply in the market, potentially leading to higher prices. Thank you for watching. Please like and subscribe.